What if I told you the United States is adding $1 trillion in debt every 100 days? Not every year, not during a crisis, every 100 days. And almost nobody understands what that actually means. Because the real danger isn't how big the debt is, it's how fast it's accelerating. And if this pace continues, this doesn't end slowly, it ends suddenly. Right now, U.S. national debt is over $34 trillion. That number is so large it barely feels real anymore. So let's make it real. If you spent $1 million per day, it would take you nearly 100,000 years to spend $34 trillion. That's the scale. But here's where it becomes dangerous. The problem isn't just the total debt, it's the interest. The U.S. government now spends over $1 trillion per year just on interest payments. Not on defense, not on healthcare, not on infrastructure, just interest. Interest is becoming one of the largest expenses in the entire federal budget. And here's the dangerous part. For years, America survived massive debt because interest rates were near zero. Borrowing was cheap. Debt didn't hurt. But now, rates are higher, which means refinancing old debt costs more, and that turns the debt snowball into an avalanche. In the past, debt spikes happened during wars or recessions, then they stabilized. But today, the U.S. is running trillion-dollar deficits during normal economic times. No world war, no financial meltdown, no pandemic lockdown, just structural overspending. And structural problems don't fix themselves, they compound. Now let's talk about the real ticking clock. Social Security, Medicare. America is aging. More retirees, fewer workers supporting them. That means more payouts and less tax revenue per retiree. By the 2030s, major entitlement programs face serious funding pressure, and that leaves only three options: raise taxes, cut benefits, or borrow even more. And historically, borrowing wins. But here's where things get interesting. The real power isn't in Congress, it's in the bond market. If investors ever lose confidence in U.S. debt, they demand higher interest rates. Higher rates mean higher interest payments. Higher payments mean bigger deficits. Bigger deficits mean more borrowing. That's the loop. And loops like this don't unwind gently. They snap. For decades, the United States had one massive advantage. The dollar is the world's reserve currency. Countries needed dollars, so they bought U.S. Treasury bonds. That kept borrowing costs low. But global shifts are happening. Some nations are trading outside the dollar system. Central banks are increasing gold purchases. Geopolitical tension is rising. If global demand for U.S. debt weakens, America must pay higher interest to attract buyers, and that's when acceleration begins. Now, you might ask, if this is so serious, why doesn't everything feel broken? Because debt crises don't feel dramatic until they do. They build quietly in spreadsheets, in budget reports, in bond auctions. Then, one day, confidence shifts. And when confidence shifts in financial systems, it moves fast, very fast. So what could actually happen? Let's look at realistic outcomes. Persistent inflation, printing money weakens purchasing power. Higher taxes, government's search for revenue. Spending cuts, politically painful. Financial repression, keeping rates artificially low while inflation runs higher. Currency pressure, slow erosion of dollar strength. Notice something? None of these are Hollywood-style collapse scenarios. They're slow pressure scenarios, and slow pressure reshapes wealth silently. Here's the deeper issue. When a country's interest payments grow faster than its economy, the math eventually wins, and math doesn't negotiate. For decades, growth outpaced debt costs. If that reverses, the system strains. Not because America disappears, but because adjustments become unavoidable. And here's the part most people miss. The debt bomb isn't a dramatic explosion. It's a shift in who pays, through inflation, through taxes, through reduced purchasing power, through weaker real returns. Governments rarely default openly, they dilute quietly. So the real risk isn't a headline, it's erosion. And erosion is harder to notice until one day you look back and realize your money doesn't stretch like it used to. Your taxes feel heavier, your investments feel weaker, and the debt kept growing. Not because nobody saw it, but because it was easier to ignore it. The bomb isn't ticking loudly, it's compounding silently. And silent compounding is the most powerful force in finance.